Gold didn't just move today, it sent a message. And if you only watched the price chart, you probably missed what the market was really saying. Because when gold makes a sudden outsized swing, the real story usually isn't jewelry demand or a random headline. The real story is confidence. Confidence in paper assets, confidence in central banks, confidence in the dollar, and confidence that the system can keep refinancing itself without something snapping. If you like clear story-style explanations like this, simple English, no finance fog, please subscribe in the next second. These macro shifts can hit U.S. markets fast, and this channel is all about helping you understand what's happening before it becomes a loud headline. Now, let's talk about the 5T day idea, because people hear a number like that and assume it's hype. But here's what's real. Gold is a globally held asset, and the amount of value tied to gold, physical holdings, central bank reserves, ETFs, institutional exposure, and related hedges is enormous. Even a normal-looking percentage move in gold can translate into hundreds of billions of dollars in repricing across balance sheets. And when the move is sharp, the ripple effects can feel like a multi-trillion-dollar confidence shift across markets that are connected to gold as a signal. So if you're asking, how can one day in gold matter that much? Well, the answer is, because gold is not just a commodity, it's a thermometer for trust. Let me paint you a picture that makes it easy to feel. Imagine two worlds. In the first world, everyone trusts the system. Bonds are stable, credit is easy, the dollar is steady, and markets assume central banks have everything under control. In that world, gold is usually quiet. It might drift, but it doesn't need to scream. In the second world, trust starts getting shaky. Maybe yields jump. Maybe a bond auction looks weak. Maybe inflation won't cool the way people hoped. Maybe recession risk rises. Maybe a geopolitical event hits. Maybe the market starts wondering if the next solution will require more liquidity, more debt, or more money creation. In that world, gold doesn't politely wait its turn. Gold starts reacting like a warning light. And here's the key point. Gold moves hardest when the market is confused about what the right safe asset even is. Because in many cycles, when things get scary, money flows into U.S. treasuries. That's the classic safety trade. But in a world where debt is heavy and refinancing is constant, treasuries can become complicated. If yields are rising because of supply pressure, fiscal stress, or inflation concerns, then bonds can stop acting like a clean safe haven. And when bonds stop acting like a clean safe haven, the market starts reaching for something else that doesn't depend on a borrower's promise. That's gold's moment. Now let's walk through what often triggers a historic gold swing, because it's rarely just one thing. It's usually a chain reaction, and the chain reaction is the story. Step one, something shifts in rates. Maybe the market reprices the Fed path. Maybe real yields move sharply. Maybe there's a surprise in inflation data. Maybe there's stress in funding markets. Whatever it is, rate expectations shift fast. Step two, the dollar reacts. Sometimes the dollar spikes on global stress. Sometimes it weakens on Fed pivot expectations. And this matters because the dollar is the measuring stick most Americans use without realizing it. When the measuring stick wobbles, people reach for anchors. Step three, risk assets start behaving weird. Stocks don't always crash immediately. Sometimes they chop, sometimes they dip, sometimes they rally on false hope. But when correlations get messy, when bonds and stocks move together in uncomfortable ways, and that's when investors start thinking, I need a hedge that behaves differently. Step four, gold becomes that hedge and flows start to hit. Not always retail first. Often it's institutions adjusting exposure. Sometimes it's central banks continuing a long-term accumulation trend. Sometimes it's a sudden repositioning around a key level that triggers momentum buyers. Then the move looks insane on the chart. But if you look under the hood, it's the market repricing trust. Now I want to tell you why this matters for a U.S. audience specifically. Because you might be thinking, okay, gold went crazy, so what? In the U.S., most household wealth lives in paper claims, bank deposits, bonds, retirement accounts, index funds, pensions, insurance products. Those are not bad. They're just promises backed by system stability. And system stability depends heavily on rates, liquidity, and confidence. When gold makes an unusually large move, it can be signaling that the market is questioning one of these beliefs. One, that inflation is contained. Two, that the Fed can stay tight without something breaking. Three, that the government can refinance debt smoothly at acceptable rates. Four, that bonds will protect portfolios like they used to. Five, that liquidity will always be available when markets wobble. Gold doesn't need all five of those to be questioned. Sometimes one is enough. Now here's where people get trapped, so I want you to listen closely. Many viewers hear gold is a safe haven and assume gold should only rise when stocks fall. But that's not how modern markets always behave. Sometimes gold rises while stocks rise because the market is pricing future inflation risk or future liquidity injections. Sometimes gold rises while stocks fall because fear is rising. Sometimes gold falls in the first wave of panic because people sell what they can to raise cash. Then gold rebounds harder later when the policy response becomes obvious. So when gold has a wild day, don't just ask, is this bullish or bearish? Ask, which kind of fear is the market pricing right now? Because there are different kinds of fear. There's recession fear, where people run to cash and short-term treasuries. There's inflation fear, where people run to hard assets. There's policy fear, where people worry the response will be messy. Tightening breaks something, easing devalues something. Gold tends to perform best when the fear is about policy and confidence, not just a simple economic slowdown. Now let's connect this to silver, because a lot of you are here for gold and silver together, and the relationship matters. Silver is not just small gold. Silver is more volatile, more industrial, and often more emotional. That means silver sometimes lags when gold moves first, and then silver catches up in a burst when momentum arrives. In many cycles, gold is the calm signal. Silver is the acceleration phase. So if gold just had a historic confidence move, the question becomes, does silver follow? Not automatically, but often. Especially if the move in gold is being driven by a deeper shift, like falling confidence in paper stability or an expectation of easier policy later. Here's the practical reason. When gold signals confidence stress, investors start looking for value and leverage. Silver offers that psychologically because it's cheaper per ounce, and it tends to move more when it finally moves. At the same time, silver is tied to industrial demand, so it has its own fundamentals. That makes silver more explosive when the narrative turns. Now, let's talk about what you should watch next, because that's what this title promises. And I'll keep it simple, because you don't need a complicated dashboard to understand the next chapter. Watch real yields, not just nominal rates. Real yields are a huge driver for gold. When real yields fall, gold often benefits. When real yields rise, gold often faces headwinds. But the most important moments are when real yields become unstable, swinging, spiking, dropping, because instability is a confidence signal. Watch the dollar index behavior. If the dollar gets choppy, that's often stress under the surface. Gold can rise even with a firm dollar in some stress events, but a weakening or unstable dollar can add fuel. Watch credit spreads. Stocks can lie to you in the short run because they're driven by sentiment and flows. Credit spreads often tell you whether the system is truly tightening. If credit stress rises while gold holds up, that's a classic confidence bid signature. Watch gold's behavior on bad stock days. If stocks are red and gold is green, that's information. It can signal a shift back toward gold acting like a hedge, which hasn't always been consistent in recent years. Watch silver's physical signals. This is important for US viewers because physical silver has a real-world market separate from paper trading. If silver's spot price is calm but physical premium stays stubborn, availability tightens, or dealers widen spreads, that can hint that demand is stronger than the chart alone suggests. And here's one signal that people underestimate: central bank behavior. Central banks don't buy gold because of a TikTok trend. They buy gold as a reserve asset when they want diversification away from pure paper exposure. When central bank buying stays firm, it adds a long-term bid that can matter more than daily headlines. Now, I want to address the "wasn't about gold" line directly because it's the heart of this video. When gold has a day that feels historic, it's often because the market is saying, we don't fully trust the normal anchors right now. In the old world, the anchor was bonds. In the last few years, bonds have been a complicated anchor because inflation and debt changed the math. When debt is huge, the system becomes sensitive to rates. When the system becomes sensitive to rates, central banks face a trap. Tight policy fights inflation but stresses debtors. Easy policy protects the system but can weaken purchasing power. Gold benefits when the market thinks the trap is tightening. That's why big gold days are often about confidence in the policy path, not about whether someone bought a necklace. Now let's make this more personal. If you're watching from the US, think about what you actually want from gold and silver. Most people want one of three things. They want purchasing power protection over time. They want a hedge against financial instability. They want diversification when stocks and bonds stop behaving like a balanced portfolio. A major gold move is the market hinting that one of those needs is rising again. But here's the part that keeps people from making smart decisions. They wait for the news to explain it in a clean sentence. Markets don't work like that. Markets move first, then the clean explanations show up later. So the best way to stay calm is to focus on behavior. If gold's move was just a one-day panic and then it fades instantly, that's one kind of story. If gold holds the move, builds higher lows, and keeps getting bought on dips, that's another story. If gold holds up while credit stress builds, that's another story. The follow-through tells you whether the confidence shift is real or just a moment. So what are the realistic scenarios from here? Think of it in three paths. One path is the fade. Gold's move cools off, yields stabilize, the dollar firms up, and the market returns to risk-on comfort. In that case, gold can chop or pull back, and silver may stay mixed. Second path is the grind. Gold holds firm while markets stay uneasy. Yields stay unstable, credit tightens slowly, and investors keep some defensive positioning. In that case, gold can trend higher gradually, and silver can start waking up in bursts. Third path is the escalation. Something forces a bigger repricing. Policy messaging shifts, bond stress grows, or the market senses a liquidity response is coming. In that case, gold can accelerate, and silver can become the faster mover because it's the more volatile expression of the same confidence trade. None of these are guarantees. They're frameworks, so you don't get emotionally whiplashed by headlines. Now, here's the confidence test I promised I'd give you before the end. And it's simple. Ask yourself this. When risk assets wobble, where does money go? If money runs to treasuries and the dollar and gold falls, that's a classic cash is king stress event. If money runs to gold even while the dollar is firm, that suggests deeper confidence stress, like a fear that paper promises are becoming less comfortable. If money runs to gold and silver together while yields are unstable, that's a stronger monetary signal that markets are trying to hedge policy outcomes. You don't need to predict the future to use this. You just observe where the flows go when markets get nervous. Now, I want to hear from you, because your perspective helps me decide what follow-up to make next. In the comments, tell me which one you think is the bigger risk over the next year. Inflation returning, a credit event, or a slow grind where purchasing power keeps leaking. And are you watching gold more closely or silver, and why? If this video helped you understand the real meaning behind a big gold day, please share it with one friend who thinks gold only moves on gold news. Sharing helps more than you think because it gets the right people thinking before the next wave of volatility hits. And here's the final takeaway. A historic move in gold is rarely about gold. It's about trust. Trust in rates, trust in policy, trust in paper promises, and trust that the system can refinance smoothly without changing the rules. When that trust wobbles, gold doesn't ask permission. It just starts talking. Your job is to listen to what it's actually saying and then watch what gold and silver do next. Disclaimer, this content is for educational purposes only and is not financial advice.